In this video, I'll show you how I use higher time frame direction and lower time frame execution to understand the real market movement. So make sure to watch till the end, because the main concept behind this setup is explained at the end of the video. Starting from the daily time frame, the market was previously moving bullish, but the latest candle started showing bearish pressure instead of continuation. That told me to avoid looking for buy positions and focus only on bearish setups. I didn't want to trade against the daily direction, so I used the higher time frame only for market bias. Then I moved to the lower time frame to wait for a cleaner sell execution and confirmation. After getting the bearish direction from the daily time frame, I moved to the lower time frame for execution refinement. First, price started forming a supply zone and showed rejection from that area instead of strong bullish continuation. Then the market created inducement below the supply zone, attracting buyers into the move. And below the market, sell-side liquidity was resting as the potential liquidity target. After the inducement formation, the market started respecting the supply zone and failed to continue bullish. This gave the confirmation that buyers were getting trapped inside the move. At that point, the bearish setup became valid, while sell-side liquidity remained the main target below the market. Once the bearish confirmation appeared from supply, I entered the sell position with the daily time frame direction. After the entry, price slowly started printing consecutive bearish candles and continued moving toward the sell-side liquidity target. This is how higher time frame bias and lower time frame execution work together. The important thing in this setup was not just the entry, it was understanding the market intention behind the move. The higher time frame gave the bearish direction, while the lower time frame showed supply, inducement, and liquidity formation before the delivery. That is why waiting for confirmation is more important than taking random trades. Most traders focus only on candles and entries, but real trading becomes easier when you understand market direction and liquidity behavior together. Instead of trading emotionally, wait for higher time frame bias and lower time frame confirmation to align. That's what helps in finding cleaner and more structured setups. This setup clearly showed how market direction from the higher time frame and execution from the lower time frame can work together. When supply, inducement, and liquidity align with the overall bias, the setup becomes much higher probability. That's why patience and confirmation matter more than rushing into trades. In trading, the goal is not to predict every move, it's to wait for the market to show confirmation. When higher time frame direction aligns with lower time frame execution, the setup becomes much clearer and more structured. That's where patience starts giving better trading decisions. So this was the complete breakdown of how I used higher time frame direction together with lower time frame execution for this setup. Understanding supply, inducement, and liquidity formation can help you avoid emotional trades and follow clearer market structure instead. If you enjoyed this breakdown, make sure to subscribe for more trading concepts and executions.